Hello, Greg.
Hey,
Oh,
Mike,
turn my volume up.
give me 1 second. I've got to switch my audio here.
There we go. We go.
Can you hear me?
I can. You're all
Oh,
good. Can you hear me?
I can hear you.
Perfecto. Let me just make sure my phone is not gonna. Oh, yep. There we go. It's on buzz. Ouch. How's your weekend?
Oh, it was good. Our weather Saturday was nice, but then Sunday and yesterday were pretty much complete washouts. So that was kind of, we've had
Yeah.
phenomenal weather. I guess we were due, but it was kind of a bummer. We had the air show here, Blue Angels. Supposed to go to a Indians game, or I'm sorry, Guardians game.
Guardians. Come on now.
Yeah, Guardians game and the air show, but that kind of got washed out on Saturday or on Sunday, and then Monday was no better. So it was kind of a, you know, it was still nice to have 3 days off, but all the outdoor stuff we thought we'd be doing kind of got shelved. How about you?
Yeah. Same story. Why is this? We're gonna turn this down. Um, yeah, very much the same. The weather you got used to August weather, and it's no longer August.
Yeah, no, we've had as much as we don't have springs anymore. I'd say the weather since June has been phenomenal here. Where pretty much whatever rain we get is minimal. So it was kind of back to reality of what lies ahead, I guess.
Indeed, indeed. All right. Well, hey, it is. It's noon, so that means it's time for lumber futures from the free seats. Greg Kuda, Westline Capital Management, Mike Wisniewski with Materials Exchange. Let's get
Hello,
right into
hello.
it.
Yeah, let's jump in. So I guess the big news is I'll let you kind of speak and explain here. Exciting news. Kind of we can read this, but kind of give us the impetus and what this means moving forward here, Mike.
Uh,
Congratulations, by the way.
thank you very much. It's really it's exciting news. Strength in numbers, you'd like to say. Two very complementary companies getting together. Mickey's got a fantastic fulfillment technology. Materials Exchange obviously is the leader in the marketplace for the digital marketplace for lumber, commodity lumber. Um, so yeah, we've put the two companies together and the technologies together, and blue skies from here.
Awesome. Yeah, congratulations. That's exciting news, and I hope you guys are on the precipice of, I know something big as it is. So hopefully this just accelerates everything forward. So congrats.
Well, it the world is becoming more and more digital. This whole idea of a digital marketplace for lumber spurred out of the futures markets going digital, which
Yeah.
that allows us to sit here and really have a better discussion about risk management. Um, it's the way of the world. So there's resistance out there for sure because it's a little bit of change, but the flip side of that coin is we are enabling a new style of business and a style of business that fits well with a younger generation for sure, but
Yeah.
with anyone who would like a marketplace with more transparency, with more accessibility, with more participation from more people.
Yeah,
So
no, I think and kind of it coincides with the belief, and this is why I embrace what you guys do, that technology and more importantly information wins, and that the whole concept of the Wizard of Oz hiding behind the curtain doesn't benefits very few, and pull back that curtain and share the information and let people make their own decisions, and I think that benefits everybody in a free market structure. So congrats.
yeah, and what's kind of wild, we're just one little sliver of this big ecosystem of the business construction, which is the raw. We're dealing in the raw material for construction. So this morning I was actually at a conference here in Chicago going on right now called Built Worlds, and it's it's an interesting group of venture capitalists, of corporate venture, of these big construction companies, or anyone involved in construction who are trying to digitize and make construction better. Um, I saw a demo for a piece of software that was amazing. It was a collaboration tool where one person on a job site with an iPad would walk around, and you could have as many people join like a Zoom call, and to survey the job site. But along the way, you could drop pins and make notes. So there would be, let's say there's an outlet in the wrong spot on the wall. You drop a pin, you say this outlet's in the wrong spot. You attach to that the blueprints or the digital print, and you highlight all the people that need to fix it.
Yeah, yeah.
Time stamped, like all the information is in one stop. Move to the next. Meanwhile, everyone who is important on that conversation is remote. So it's there's things like that are just under the surface that'll be coming to be normal in a very short order. So
Yeah, no, I think it definitely helps modernize supply chain issues, and we all know going through what we just went through with the pandemic, technology isn't a bad thing, just the opposite. It should be embraced. So good things lie ahead for sure.
information is key. All right, so let's get some information out there. What's going on?
Well, we'll start big and work into lumber and housing. I think the big thing, the big takeaway week over week is the fact that interest rates, you look at the 10-year note continues to bubble higher. So really, you're within 1 or 2 big days of retesting the recent highs. And I think when you look at what the Fed is doing here, inflation is on the forefront. That is what's, their laser focus, so to speak, is on inflation and what they can do to control it. And assets in general are under significant pressure as a result. And when you jump into I think this kind of speaks for itself. There are very few safe havens this year. Energies have been the beneficiary, and you've given quite a bit of this back as of late. But really, when you look at kind of safe havens like gold, I'm not even going to touch Bitcoin, but really, how many people had the foresight to move their money into the FTSE or into the Nikkei, Japanese? I would say almost 0%. So really, where do you put your money? The reality is you're getting some rate of return now with interest rates, money market accounts, CDs, treasuries. So there is another place to earn something. So you don't have this all-in approach to equities, and I think that's kind of where you're reshuffling the deck here as far as how people see assets, where it's not that all-in mentality. And I'm a firm believer you don't fight the Fed, and when the Fed is handing out free money, you're all on board. When the Fed tells you no, interest rates and inflation are on the forefront of what we need to do, all asset classes are suffering here as a result. You don't fight the Fed, pure and simple. And when you kind of jump into what this means for commodities, um, you know, to me the obvious thing here is the U.S. dollar continues to make new highs. The euro dollar and some of the other residual currencies out there, global currencies, continue to make lower lows, and as a result, commodities as a whole are struggling to kind of under the pressure of this is exactly what the Fed wants. That they want higher interest rates to contain inflation, and they want a strong U.S. dollar to make our goods less expensive globally. And so the negative result is just you have commodities under pressure as a result, and lumber gets lumped into this as well. And then when you look at, you know, this is 1 month returns. You've got the obvious build in anticipation of winter with this is heating oil, natural gas, U.S. dollar, Goldman Sachs commodity index. These are the big beneficiaries. And then when you look at the losers here, Mike, what jumps out here? Well, here's good old lumber, but more importantly, euro dollar, New Zealand dollar, British pound, Japanese yen, um, and then you get into the equity markets. So again, this is, to me, it's just everything to do with the currency war and effect of dealing with inflation and making your goods cheaper, not only domestically but on a global basis. So you see the net result with the euro. This is the first time in 20 years that the euro is at a 20-year low. You're basically on par with the U.S. dollar, which is just huge. And then when you look at this globally, here's the U.S. dollar, and then look at euro, British pound, Japanese yen. Again, this is the Fed's mindset. This is what the Fed's trying to accomplish right now, pure and simple. You don't fight the Fed, and assets as a result are going to be under fire here for the foreseeable future until the Fed gives the all clear with inflation.
Yeah, and they've been very transparent about what their goal is.
Yeah, no, and I think I know you wanted to touch on jumping into the energy markets here and the implications, ramifications of what lies ahead for Europe and gas. These are the big headlines just this morning. Russia has cut off gas supplies to Europe indefinitely. German gas giant Uniper says the worst is still to come after Russia halts flows to Europe, and OPEC kind of thumbed their nose globally here and did a symbolic rate. I'm sorry, a symbolic oil production cut. The expectation was to leave well enough alone, but they actually did a small cut. So this just goes to show energies, the energy markets, natural gas, just on a global, on a global basis, are going to be huge as we move forward, and going to be major geopolitical ramifications as a result, not just for Europe, but the trickle down effect for everybody else.
So what I was thinking about lumber, and it known at what is the professor of economics,
Yep.
um, and it has about an 18-month lead time. And if you go back in time 18 months ago, um, what was happening in lumber is exactly what's happening right now in the energy markets.
Yep.
Um, what I will be curious to see the first time you take a look at the energy markets, and I immediately go back to my personal wallet. When I go to the gas pump, I feel it, right? When I'm paying an electric bill or a gas bill, you feel it. But can you imagine if you were running a sawmill, a massive sawmill in Austria or Germany that is really technical, that is, completely computerized, all kinds of motors, and, the energy consumption. What's going on with their energy bill?
Yeah.
What's going on with the bill to operate their dry kilns? It's amazing. I was talking to someone, and I didn't fact check this, but evidently firewood and wood pellets are more valuable than finished lumber in some parts of like Latvia, Lithuania, in those regions.
Yeah. No, you want to talk about kind of going back to very crude, efficiency goes out the window when you're cold and you need to heat your house, and simple stuff like firewood and wood pellets. It's just going to be very interesting to see how Russia yields one of their few hammers right now, as far as complete control, or 70% control over Europe and Germany right now, as far as, okay, we're going to shut you off. What are you going to do about it? And when you look at U.S. crude stocks, historically speaking, here we're well below our 5-year average. And we're trending down here. And typically this is when you trend down in anticipation of, this is where you get the switch, as you switch from unleaded gas. When you crack a barrel of crude, the byproduct is unleaded gas and heating oil. Excuse me, get rid of this call here. When you crack a barrel of crude, the byproduct is heating oil and unleaded gas. So this is where you get the shift out of unleaded. It's Labor Day, so driving starts to slow down, and then you start to get the build in anticipation of using heating oil and natural gas to heat. So you see this um, Here's gasoline stocks. You'll start to see these build now, or in theory, start to build. Um, and then here's fuel oil, heating oil. You'll start to see these stocks start to, as you start to ramp up consumption here, as you move into October, November, these will start to dissipate. But you could see you're already starting from historically low levels to begin with. So as much as I want to say, get used to lower prices at the pump, this kind of pullback, and I'll go back to kind of this gives good perspective on crude oil here. You've come a long way off the highs. The idea of lower lows, I think OPEC and Russia are going to have something to say about this.
Uh, yes, this whole energy thing to me right now is the big unknown. This is what we didn't anticipate, um, and the headlines where you see the worst is yet to come. I mean, it seems pretty darn bad right now. They got the gas is shut off. So um, this is something that I'm definitely keeping an eye on. I think it's really important that we watch.
Yeah, absolutely. And we'll update this on a weekly basis moving forward. Uh, so we'll jump into housing now. And I don't have that much because I think there's a lot with lumber to fixate on. But I saw this morning from Lawrence Yun. He's the chief economist with the National Realtors Association. And so you look at the change in housing from, so this is the median single family home price. You look at 2000 to 2010, kind of a mild, you're still in this deflationary period. And then, look at the jump from 2010 to 2020. And I would have to wager that 2020 to 2021, 2022, you're up over 4,000 or just sub 4,000 now. But you finally have inflation entering into the mix when it comes to housing, probably at the worst possible time if you're in the housing market. And then when you look at how is this starting to impact home buying sentiment, this is from John Burns Real Estate, a great advisory service. But you can see, percent of buyers who have switched from wanting to buy a home to choosing to rent a home or apartment due to higher mortgage rates. And look at the top three here: Texas, Southeast, and Florida. And you ask any home builder, you ask any supplier where your three main areas. Well, it's the Carolinas, it's Florida, it's Texas, and this is kind of prevalent as far as people getting priced out of the housing market right now.
I think going back to what you had up there too about people anticipating a collapse in housing.
Yep.
Um, I don't know that we're going to see a price collapse, but I could see us trend lower, lightly lower. You see, I read Toronto has had significantly lower house prices, and this can happen just because people are moving into smaller homes as well. You just don't build some of the bigger ones; you build more of the entry level small homes.
Yeah, and so I agree, Mike, in that the difficulty with the house pricing collapse is, okay, great, you have to go somewhere else, and if I'm going to sell my house at a lower price, do I get the benefit of that? Okay, I mean, you're going to make a horizontal move, or you're going to make a vertical move, or are you going to go from, maybe you get the baby boomers aging out from ownership to rental, so that brings more houses on the market, but there's still an undersupply of housing out there, and
Correct.
people have to go somewhere. And if you own something now, the idea that you're, just to sell, you still have to go somewhere else, and that's where it's easier said than done. And again, personally, I don't think this is going to be anything like 2008, 2000, 2007 through 2009. I think that housing is going to have its ebb and flows, and right now the beneficiary is multi, the loser is single. But by no means do I think 6 months out, a year from now, that can't change or it won't change. Where I don't think this is going to be a complete destruction for the foreseeable future. I just think this is going to be the ebb and flow of housing. And right now, multi is the beneficiary, single family is the loser.
Yeah, and I mean, this is a big oil tanker we're trying to move. It doesn't happen overnight. So this is a multi-month, multi-quarter shift that we'll see moving
Yeah, and
forward.
then the last slide I had for housing was this is again from John Burns Real Estate, DIY customer traffic. I wish this was a little bit clearer, but you can see how you continue to see this weakening trend of the DIY crowd. So don't expect this to be the savior from a demand standpoint, especially this time of the year, even as prices start to come off at the big box level. I think there are so many kind of red flags out there with the economy and uncertainty that people aren't just going to blindly throw money into DIY projects. It's just the wrong time of the year, and there's just too many red flags out there. Just to just to blindly spend money when it comes to housing DIY projects, or I'm sorry,
Agreed. Agreed.
DIY. Let's jump into lumber.
All right. Lumber, lumber,
So
lumber.
we'll run through these pretty quickly. You still have an elevated high implied volatility when it comes to lumber options. So even though we're settling into a more normalization of lumber prices, and we're not having these wild extreme moves, we're still coming out of a high volatility period. So we still have elevated implied volatility when it comes to lumber pricing. Um, Kind of we're in the spot month now. So what can we look at as far as total EFPs? This slide is as of last week. I didn't update it because there's only been one EFP since. So we have 9 EFPs September contract to date. If you look at July, we had 221. If you look at May, 282. March 201. If you want to go back and look at September a year ago, you had 55. So, okay, are we going to do 50? Are we going to do 100? Are we going to do 150 with total open interest in September at 330? You have to think that a big chunk of those leftover Septembers are going to be EFP'd off the books. And with, jumping into, I'm going to come back to this, Mike. I'll come back to this as well. But I just want to, what was I going to show here? Um, Jumping too far forward. You have to think with, I'm sorry, I was going to, I lost my train of thought. I was going to go to basis here. So here's basis. You've had basically complete convergence with
Correct.
September and cash. You could even make the case now that September is at a premium to physical cash with some of the numbers. Hearing a volume trade last week on Western SPF 2x4s in that 470 to 490 area. So you could make the case that September last trade at 491, is that the spectacular buy to EFP? The answer is probably no. The reality is, if you're just going to go buy physical cash, you're going to get a better deal there. So as much as we want to think that September um, can conceivably have some type of bigger spike or surge to the upside, and I'll go back to the weekly chart here. The reality is any premium that you can get in September relative to physical cash, I would have to think that the mills will see this as a sell opportunity, especially knowing that if we're going to do anything near historical EFP levels, um, the mills, knowing what the CFTC numbers look like, my guess is that there's going to be lots of interest to sell any bigger rally in September through now and through expiration.
Yeah. When you get to the basis being right at par or zero, it could go either way.
Yeah, so here's the September daily. There's not, again, this was a snapshot at 496. Right now we're 91.40. To me, there's nothing exciting or obvious about September here outside of the fact that it's 25 to $30 over November, which just doesn't make a lot of sense. So if I'm going to look at where I think perceived value to be in September, you're probably talking about a retest of the recent low in this 470.60 area down through the Bollinger Band low, this 455. To me, this is where you're going to bring in new blood to take September, new EFPs. If I'm a sawmill and I get any rally back to 500, 510, 530 or higher, you're not capturing anywhere near those numbers in physical cash. So I would have to think that that becomes a good sell opportunity for the select few that are still due EFPs in September.
Yeah, all the rumblings we're hearing in the cash trade is the bids are significantly lower.
Yeah, yeah. And again, all rallies start with a short covering rally. Okay, great. But we say this over and over again. Now's not the time to assume anybody's risk. And if I'm a lumber buyer, I'm buying just in time, kind of needs 30, 60 days out, and then I'm kicking the can down the road. I'm not going to assume somebody else's risk of ownership. If I have to pay up, so be it. But the idea of seeing a bigger rally, you're going to need some kind of fundamental shift to kind of make people see value and embrace the idea of inventory accumulation. And until you see inventory accumulation, I think this market is going nowhere fast, and the likelihood of seeing seasonal lows, kind of go back to the seasonal chart here. Um, Seasonal lows are still ahead of us into the middle of October, middle of November. And you can see this little green line is current. And you look at the last 2 years, well above today's levels or right at today's levels. You look at the last, pre-COVID type numbers, you're well underneath. So we know that lumber is starting to normalize from a price standpoint, but can anybody look at anybody else with a straight face and say at $490, this is extreme value? You should be inventory building at this point? No, the answer is absolutely not. You don't assume anybody else's risk here. Worry about your own risk, and that's the difficulty, is that this will play itself out, whether you belong at these numbers or you're going to have a reversion back to mean type numbers. But right now, the idea of staying small probably makes a lot more sense from a risk standpoint.
And from the just uncertainty, we can't
Yeah,
hang our
yeah.
hat on the information we have coming in.
Yeah, and so you look at September, and again, this slide was these are historical September closes. This is as of last week. You're still within $10 of this $500 price. So historically speaking, I know we talked about this 2 weeks ago, Mike.
It's a great
September
price.
at $490 is still the second highest expiration level in the history of September lumber. So, again, the idea that you're going to be sold this bill of goods, that this is extreme value here, well, history suggests otherwise.
We have to acknowledge input costs are a little different, but
Yeah, absolutely. But what's the old saying? No, nobody cares about your cost. If you don't like it, then do something about it.
yeah, exactly.
So then here, you kind of shift into, we have September in this 490, 495 area. Interestingly enough, today, November made a new lower low here at 456. It's 465 last. So the path of least resistance is still chopping around in this little narrowing triangle coil formation. Again, worst case scenario, best case scenario, if you're trying to build a position in November, is you ultimately get this flush to last year's lows of 448, sub 448 into the Bollinger Band low of 422. Obviously, the lower you go here, you're going to see more interest to forward buy, to cover existing jobs or to inventory build. But this is where you're going to see your inventory build. When you look at, I'll come back to the spread here, but when you look at the forward curve, even though this looks extreme here, this really isn't that big of a difference between November into January, January into March. But this is kind of the reality of where you're going to see people build out inventory in futures because of the cost of carry, because of the limited cash outlay. I'd rather own my inventory here and then convert it into physical cash as the jobs come due.
Yeah, I think that forward curve, like you said, it doesn't look that bad, and we start putting the nail in the coffin, if you would, on 2022 and start looking to 2023. I think you're going to have lumber buyers say $500 for 2023. It's probably not bad.
Yeah, and that's where, time heals all wounds, and everybody's still fixated on this year. You need to churn the page and get people to start thinking about Q1, Q2 needs, and you're just not at that point in time yet.
No.
Historically, again, you're there middle of October, middle of November. So, this is where everybody is still thinking about this year and not thinking about next year. And that just takes time to kind of shift that thought process. But, I want to go just hit on the spread. So, this is the confusing part. We talked about going into month end, how you get the commodity fund rolls, rolling their September shorts into November. True to form, the spread really didn't give anything back. The vast majority of volume was done in this 20, call it 25 to 30 over area. And then once the funds stopped rolling, you had a quick pullback on Friday into the negative 14 area. You actually got back out to negative 3140 today as you had more shorts rolling September into November. But the thing that, and I'll come back to this one, but the thing that doesn't make sense, look at NovJan, look at the next spread out there. That NovJan spread is trading, it traded in a range today of negative 2580 to negative 2890. So you've got NovJan 25 to 28 to 30 under, you've got SEPNOV at 20 to 30 over. Somewhere in between lies the truth. And I understand September's a liquidating contract, but the idea that anybody would want to get long SEP 30 over November when November's trading 25 to 30 under January, if I'm long September here and I'm not going to EFP, my only suggestion would be take advantage of rolling your September at this massive premium to November, and just move your Septembers into November. If you're not going to EFP with the sawmill, I really don't see the advantage unless you know something or think there's going to be a squeeze in September. It doesn't make a lot of sense for September to carry this premium to November, especially when, again, you look at the next spread out there trading at 25 to 30 under.
Well, this is a danger zone for September. I mean, it only gets less and less liquid as we
Yeah.
move forward in time.
So from a basis standpoint, here, anybody wants these, just let me know. Here's the mini curve, very similar. You're carrying slight premiums in the mini contract. I think that's just more the liquidity than anything else. And we'll hit on the mini contract at the end of this. But here's the September basis, and again, this was as of I'm sorry, this is a week ago. And then as of today, you're basically even money. You've had convergence or within $5, $7 between SEP and physical cash. When you look at November, again, I'd rather own the cheapest wood out there. November represents greater value versus physical cash unless you need the physical cash today. Um, and then when we look at open interest, this is last Monday, 2368. Fast forward, we keep seeing this build. So even though we're getting the liquidation in September, we're still adding more Novembers and more Jans. And, what do you attribute this to? Again, if we look at the CFTC numbers, Mike, the obvious build continues to be with managed money shorts. Um, Back over 1568. So the funds, now that they've shifted their attention out of September into November, continue to see November as a sell opportunity. And we know at some point you're going to get some kind of bigger short covering when it comes to the commodity funds. But when you look at the US dollar, you look at equities, you look at what the Fed is doing, I personally don't see it anytime soon, unless there's some kind of dramatic announcement when it comes to lumber that alters the fundamentals. The commodity funds are established in this position. The reality is they're in the money, $300 to $400 a thousand, and going from July into September, September and November, do they cover into the seasonal lows? Maybe. I'll believe it when I see it. But the reality is the funds are here to stay. And this just kind of, again, allows for some great trading opportunities, especially when it comes to the spreads, knowing that the managed money funds are the largest percent of total open interest here. So you want to pay
When
attention
you
to
under
this.
yeah, when you understand market structure, I mean that's the key to everything.
And the other thing I'll point out here, okay, who shorted this market? Well, it certainly wasn't commercials. It certainly wasn't I'm sorry, let me go back. Certainly wasn't the mills. I mean, only 162 producer shorts. Managed funds took the place of the mills here on this down move, and they got to capture the $300 to $400 a thousand on the way down. It certainly wasn't
What's
the mills.
what is your sense on these EFPs? I mean, are you hearing that there's just nobody on the short side available?
No, no. I mean, I think that the usual suspects are there, and will do their EFPs on the long side. So, I think at a minimum, you're going to do probably 50 Septembers, if not more. 50 to 100 is my guess at a minimum. It's just this cat and mouse game of, when you look at, go back here, when you look at September open interest, how many are already established in this 330? Okay, you're going to do 100, you're going to do 150. What's the speculative position left in September? And that's always, the $1 million question in trying to, what's left here. You have this week, you have next week, so you still have plenty of time, for this to play out. But the idea that you're going to squeeze September until you can prove that cash has found a bottom and print's going to stop moving lower and the mills are going to stop taking lower prices, it's tough for me to get excited about futures and picking a bottom, especially in September when you can't bottom out in physical cash. So any attempt to get September at a premium to cash, I think that's a sell opportunity. That's not a buy opportunity. November becomes the buy opportunity. Physical cash becomes the buy opportunity. If you need the prompt wood, you go out and find the deals there. But the idea that you're going to bring all this speculative buying into September, for me to believe that, Mike, you gotta put a bottom in on cash. And as much as I want to say we're there, I don't see signs yet that we're there in physical cash.
I just look at this and I'm doing quick math in my head. I mean, 162 shorts on the commitment of traders reports and open interest of 330 still in SEP. There's people that are short SEP that are not sawmills.
Yeah, yeah, no, and like to me, okay, the industry is long, and they should be long. This is, again, that forward structure. You should be carrying your inventory in futures, not in physical cash. But best case scenario. So when I look at the hope strategy, okay, we hope that these guys get stopped out to generate some kind of big rally to the upside in physical cash and futures. Well, where's the hope here? The hope, if if I'm a producer, I'm hoping these guys get stopped out to allow me to assume their position. But so far,
Yeah.
that hasn't happened.
No.
So you'd be more than happy on a rally to take these guys out and transfer these shorts into commercial shorts. But that's the hope strategy right now.
And so far, every time we get a rally, we see a build in managed money. They keep selling it.
Yeah, I mean, the other thing you would look for, another sign of a bottom, is obviously you start to build longs with commercials, the industry itself, but also manage money. Somebody else starts to see value. Hey, we're there. But unfortunately, to me, I think you'd have to have November sub 450 or even sub 400 to get these guys to think about just, what, we're done rolling. Let's liquidate our position. Let's go long. Because historically speaking, there's nothing significant in the grand scheme of things. Okay, I know last year's low was 448, but trying to compare last year versus this year, fundamentally, you're comparing apples to oranges. And when you looked at historically where lumber typically goes into the seasonal lows, it's tough to tell anybody that there's value in September at 490 to $500. Maybe there is, but it's tough for me to see it. Personally, I don't see that right now, and that doesn't mean you have to have this imminent collapse. You have to go to some extreme number. If these guys stop selling, then that could be the catalyst for a rally. Who's going to sell this market? Well, we know producers, the industry is not going to sell down here. So if these guys stop selling, that could be reason enough to kind of get a bounce. And that's probably why, from an industry standpoint, you're going to see more interest to buy November. The industry is probably done selling November right now. They're looking to accumulate November. They're looking to accumulate the price curve in futures because you're already getting to extreme levels to the downside. So that's something else to watch. I'm going to watch. Do these guys decide to exit? Do they decide to go long? Because you're unlikely to see this build on any further weakness here.
So I'm gonna wrap it up here, and I think the themes going on. First and foremost, September rolls off the board next Thursday, so we got 6 more trading days.
Yep.
You have the spread market, which is causing some confusion. But a lot of that's what's confusing in the spread market is a function of the market structure, meaning who's long and who's short. And we have non-industry people short and kind of industry people long. And then, the last kind of wild card story for me is the energy situation in Europe. While, it's definitely a second or third derivative out there, but it matters because of all the European wood that's coming to the States. Or will it stop coming to the States?
Yeah, no, I think there's a lot of uncertainty out there, and that's going to be the continued theme. You need stability, and my big offs, Mike, are don't fight the Fed and
don't fight the Fed.
Don't fight the Fed, and put in a top in the U.S. dollar. It becomes a lot easier. So how do you pick bottoms in these other commodities, including lumber? Well, it's going to have to be some other underlying fundamental rationale reason, whether it's geopolitical or some shift in the demand supply structure. But until you see that, assets are risk off right now, and that's what the Fed wants. As much as people don't want to believe that, when the Fed is telling you that inflation is number one out there as far as what we're worried about, well, your free money is coming off the table, and the Fed's going to continue to push interest rates until they feel inflation is under control, and they're going to do that twofold. They're going to raise rates, and they're going to influence a higher dollar structure to rein in inflation. And those are my big continued takeaways here.
Makes sense to me. So next week we will most likely be broadcasting from Columbus, Ohio, attending the Trust Builder and National Framing Council or Framers Summit. And I will have an ear open to hear what they think of business.
Yeah, Mike, I'll be down there. Columbus is 2 hours from where I'm at, so I'll be down there. If anybody wants to meet up, or if you're going to be down there, I'll be down there Wednesday and Thursday. And if anybody's going to be at the Do It Best show this weekend, I'll be there as well. So
fantastic!
Reach out.
All right, sounds good. Thanks everyone, and have a safe week. We'll see you next week.
Thanks a lot, Mike. Thanks everybody. Take care.
Hey, Greg, hang on, okay?
Okay. Yep.